Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Now, today I want to talk about systematic investment plans. And I know you've probably heard quite a bit about this, but bear with me because this is not necessarily meant for you, at least part of this is not meant for you if you're a seasoned investor in mutual funds. You probably are doing the right thing in keeping your SIPs going. This conversation is for you to show those people who've probably been asking you what they should do with their SIPs. Should we stop our SIPs? You probably been asked this question in the recent past with the markets behaving as they have done. And I'm not talking about today, I'm talking about the last few months. We'll address that, and we'll also talk about how you should approach your SIPs if you've ventured a little too far into the broader market mutual fund schemes. To talk about why you should probably keep your SIPs going, I'm joined today by Santosh Joseph, who's the founder of Germinate Investor Services. Santosh, thanks as always for taking the time.
Hi Alex, good day to be in the newsroom.
It's a good day indeed because the markets are finally showing a color of green across the screen, and it's hopefully something that will last, will be durable. But let's talk about this and allow me to set the context for this. Let's pull up some data, right? Because first, to set things up, we're talking about an SIP cancellation ratio. Now, this is something that you've probably heard of. The Association of Mutual Funds in India shares data on a monthly basis, and in the latest available data, that is the data for the month of February, you will have likely noticed that the SIP cancellation ratio is the highest that it has been in quite a while. That number stood at 122%. And what this number means is that in terms of the new folios, SIP folios that are being added, this is less than the number of folios that are being stopped or paused or that are finishing. So you have, in certain cases, a 6-month SIP or a 12-month SIP, you have a lapsing of those SIPs. So what it means is that as a percentage of the new schemes or the new SIPs that are started, the schemes that are stopped are 122%. It stood at 109% in the previous month, in the month of January, and it was less than 100%. It was 82% and 79% in December and November. What that means is that till the month of January, you had a consistent increase in the number of SIP folios on a month-on-month basis for quite a while, and January and February, that number has actually shrunk. Santosh, is this a sign of the times where another instance of greed and fear is becoming visible, where now fear is palpable and you saw a considerable drawdown in the markets in the month of February and in January?
Well, it is definitely the sign of times. We take the data as it is. But Alex, I must thank you for explaining this entire SIP ratio so well, because it doesn't mean that we are stopping. You are clearly given a breakup that the percentage of SIP ratio stoppage is keeping in mind the month-on-month number. So therefore, I think you get a beautiful context over there. Now, we also have to remember that way before we were net positive, we also had a slightly higher seizure rate because the industry is large now. You are well over 10 crore SIPs live and kicking every month. Now, on such a background, a few lakh SIPs being added every month and being stopped every month, though should be seen from a pure data metric, it should not be worrisome. Now, the second part why I tell you is a sign of times is that there are many people who signed up for SIPs more ambitiously, maybe committed to more than what they should, or maybe committed to more funds than they should, or maybe sometimes even at some minor sense misinterpreted what an SIP was. They thought SIP was an easy way to make money and they would not lose money. And at the first sign of trouble, they seem to be abandoning the ship by stopping SIPs. So I think that we still have to celebrate the fact that many new SIPs are getting added month on month. But we also have to do something to ensure that people are well informed about what an SIP is and what a SIP is not. And therefore, if you were to match the objective with the risk reward, then I think you will reduce the seizure or the stoppage rate.
Yeah. The natural tendency, of course, is when you are hurt, you duck for cover, right? Or if you put your hand too close to something that is hot, you pull back. This is human nature. So let's pull up why investors are likely doing this, right? So I've pulled up the month of November to February data on a month-on-month basis, the performance of each of the benchmarks. So first I've taken the Nifty 50, and you've seen a drawdown in 4 months in a row. This has not happened in close to 30 years or thereabouts, right? So it's not something that has happened very often. 6% nearly in February. You've had a decline in all of the previous months as well for the Nifty 50. The broader markets have actually fallen much more. In the mid-cap index, for example, you have nearly 10.6% of a decline in the month of February, declines in the month of January as well to the extent of 6%. So quite a bit of pain in that mid-cap segment. And the small-cap segment saw the worst of the selling, where you saw February decline as much as 12.7% and January dropped as much as 10.7%. Now, remember, this is just the index. If your fund or the fund that you're invested in has performed worse than the benchmark, then you've seen further drawdowns. So, Santosh, does this drive home the point that people have seen losses, they're a little frightened, and they pull the plug?
It's both, Alex. Again, good data points. Most of the data is self-validated. You really don't need to add much to this. But the interesting part here is that the last 4 months data where you had consistent 4 weak to negative months that we haven't seen in over 2-3 decades also tells us that flows in the market, flows into funds, flows into SIPs are directly proportional to how the markets function and how markets peaked out sometime in September, October last year. If you go back to look at mutual fund flows, if you go back to look at SIP numbers, if you go back to look at the collections in thematics or small and mid cap, all of them by and large peaked around that period. What does it tell you? That so much of investor activity is led by this momentum style of investing, that they chase performance, or they like to enter into a happy party where there's money to be made and everybody's making money. So you also enter with the hope of making money, and suddenly you have an abrupt 3-4 months where there's no money made. They feel that they made a mistake and SIP is not for them, forgetting for what they entered, and they quickly unwind the position by stopping the SIP or withdrawing the money from the investment, thinking that maybe they got caught on the wrong foot or something is wrong, not realizing that this is just supposed to be the normal way markets function. Whatever we had, a non-stop rally is normal, and even the 4 months where the markets corrected is also a day-to-day activity in the market, that markets are two-sided and never a one-way street.
Okay, so let's elucidate this point, because this is the context, and hopefully you've stayed with us through this point, because now is the operative part and the reason why you should not stop your SIP. I asked Santosh to give me some data of the recent past, and I know that if you go back long enough, you go back 30 years, you'll find several instances where the markets have crashed and you can pull up data. But I know what a lot of people also say is that, oh, you can't go that far back and this is now. So what we've done is we've actually looked at data from October 2021, right? 31st of October 2021, and we've looked at over a period of the next 9 months or so, which are the schemes that underperformed the most in the mid cap and the small cap category, and Santosh has pulled up this list. You will be familiar with 30th of June 2022, which is approximately when the Ukraine-Russia war started. And this is when markets have underperformed in a big way. So these schemes have lost quite a bit of value. What Santosh has pointed out is that the SIP returns of some of these schemes has been as low as negative 29%. Now I'm going to let him explain what happens if you continue your SIP, or if you had continued your SIP beyond that point. Santosh?
Yeah. So like we are facing right now in 2021, on the back of a COVID low, market had made a beautiful high. So many people came into SIPs, and the data here we have taken is of 2021 October onwards. Now, for making this data even more further fine-tuned, let's take the calendar year 2022. The year began normal. By Feb and March, the Russia-Ukraine war started. And by the time you came to June, the market corrected over 10-12% and kind of bottomed out in the third week of June. Now, most of the guys who started SIPs from October, November, December 21 or early part of 22, by the time they came to June, their SIPs were negative. And by the time they came even to the end of 2021, their SIP are looking at maybe 15%, 20%, and in some mid-cap, even 25-30% negative. Now, it tells you that in the short term, like 6 months, 9 months, 12 months, and maybe even 15-18 months, the SIP that you saw were aspirational about making you a lot of money can also turn negative. But here lies the interesting part. If one did nothing and just stuck to the same SIP, the SIP that really took a significant beating, and waited for exactly 12 more months from 2022 June, where the market formed a bottom, to 2023 June, or maybe even 2024 June, that negative 20-25% return became a positive 18, 20, 22% return. What does it tell you? That even in short periods, where 2-3 year periods we talk about, when the market has given you that decent 10-15% correction, if you're not going to get perturbed by it, let your SIPs continue and let the SIPs do the charm and the magic that they're supposed to do by accumulating more units. When your markets are falling and NAVs are falling, not only will you make money, but you will recover the losses to go on to make a nice, smart, double-digit positive return. Now, that's the numbers that you see on screen that tell you that even though the correction is real, the fall is real, the SIP returns are negative for real, but even the reversal or the bounce back and making money is real.
Okay, so quick question here is the use of lump sums. Of course, savvy investors will use opportunities to rebalance, and this simply means that if you had a 70% allocation to equity and a 30% allocation to other assets, and because of a fall in the equity markets it's fallen to 60%, you simply rebalance, put money from one asset class into the other, and you can deploy it using a lump sum. But sometimes people feel that they've mistimed it. Would you say that there is a solution to that, or you simply should follow your strategy, which in a lot of cases is mathematical, and so therefore emotions don't come into play?
I think largely, Alex, if you've started with the right strategy, then don't worry about the performance, right? It will come about. And that's exactly what the data is suggesting. But here's a very interesting point. If you started off on a more aggressive, avaricious note where your portfolio was skewed, right? And not to forget, whether it's lump sum or SIP, we know that in the year 2023, 2024, bulk of the collections came in mid cap and small cap or thematics, which means people were chasing performance. Now, whether it's an SIP route or lump sum route, if you have gone overboard on your asset allocation, every time, as soon as you realize it, is a great time. And a market correction is a great wake-up call for you to correct that. Now, you can correct the lump sum by adjusting the volumes of the money that you have. Especially if you're an SIP, you can ensure that your next incremental SIPs are adjusted for what you actually want your portfolio to contain. If you're committed to 100% small and mid cap, or if you're committed to 100% some other category, and you feel that the last 5-6 months of correction is giving you a reality check, it's a great opportunity to realign your SIPs.
So let me ask you this. I know that it's a little bit broad-based and it's a bird's eye view situation, but a lot of people are facing drawdowns in their mid cap and small cap schemes. Should they sell out of those schemes if they've overexposed, or are you saying that you should pause those SIPs or stop those SIPs, and all incremental investment should be made to a larger cap fund, thereby you adjust your incremental investments?
Okay, so I'm going to give you a not so popular answer. Number one, if you've got an SIP running in mid cap and small cap and you've taken the drawdown already, one would think it will make sense to continue your SIPs. But if you feel so strongly that, I made a mistake, right? Then what you do, you stop the SIP in mid and small cap and you go to whatever fund that suits you better, but at least let the smaller mid cap fund continue so that, the recovery process is happening. Now, the new funds, you can take a call based on your needs, your risk analysis today. But the most important part is if you got in, ensure that the withdrawal is not abrupt, and the drawdown doesn't worry you too much, because remember, the last 4 5 months, whatever drawdown we've had, one good month, like we have a great day today when you look at the broader markets to even the larger index, 1 or 2 weeks and 1 or 2 months when the markets recover, all your losses can get wiped away. I'm not saying it'll happen very quickly, but please be mindful of it. Do not take this kind of knee-jerk reaction. Be fundamentally rooted. And if you get a chance like times like this to correct, use the opportunity to course correct it, whether the lump sum or even the fresh SIPs that you can reallocate.
And the operative word is do not stop those SIPs. If you have to repurpose them, do so, but keep them going, because these market drawdowns are ultimately the best time for you to accumulate the units that will hold you in good stead down the line. Santosh, thanks so much for joining me on this conversation. Very important one to have, and always a pleasure.
Thanks, Alex. I think you summed it up well. We just have to keep the SIPs going.
Absolutely. All right, so that's a very important point that we've just spoken about. And like I said at the start, it may not necessarily pertain to you, but you've probably been asked this. If you are a savvy investor, if you are an experienced investor, your neighbor has probably spoken to you, or your friend, you should speak to them about this video, and you can share it with them.